things have kind of stopped trickling in, so we'll go ahead and get started here. Again, welcome to today's webinar. The presentation for today is going to be over after-tax rollovers and mega backdoor Roth strategy. Again, my name is Sydney Rutledge. I'm a financial advisor here at Bogart Wealth, and let's dive into today's presentation here. First, just a couple of quick words about Bogart Wealth. For those of you who might be new to our firm, our mission is to help our clients achieve peace of mind by preserving and maximizing intergenerational wealth. We really pride ourselves on providing education to our clients and to their families. Some background numbers on us. We are the trusted advisor to over 1,200 households all across the United States. We have over 2.6 billion assets under advisement, and we custody our assets with Charles Schwab. That's for protection for our clients. We don't hold our clients' money at Bogart Wealth. It's held at Charles Schwab, which is away from our firm. And we are also a fee-only wealth management firm. That's for transparency for our clients. And we are a registered investment advisor, which means we have a fiduciary duty to work in our clients' best interests instead of our own. We have financial advisors located in both McLean, Virginia, and Houston, Texas, in the Woodlands, Texas, but we do, as I mentioned, service clients all over the United States. We do have a pretty robust team here at Bogart Wealth. We have a full management team, compliance and marketing departments, as well as on-site operations and financial planning teams. We do also do our investment management in-house. This adds a level of transparency for our clients that we feel is very important. And we do also partner with a local CPA firm in Texas to help our clients with their tax preparation needs. We have 3 office locations. Our headquarters is located in McLean, Virginia. And then we have 2 offices in Texas, one in Houston and one in the Woodlands, which is where I'm located. For those of you who work with us, you know that financial planning is at the heart of what we do. Most people think of planning for retirement as just about the investment management piece of it, but everyone's situation is different, and it's important to focus on your goals and manage the issues that are important to you. If you're new to Bogart and have not gone through our planning process, I highly encourage you to reach out to myself or one of our other advisors so that we can talk specifically about the goals that you and your family are working towards financially. You'll notice on this graphic here that it's a circle. That's because we believe that retirement planning is something that is never done. We like to update your financial plan periodically to see what's changed in your life and see what other optimization points we can take advantage of for you. Alrighty, now let's jump into today's topic at hand. Today's webinar over the after-tax rollover and mega backdoor strategy is a part of our retirement readiness series. You can see the various topics here. We do have we produce a number of educational webinars throughout the year. We advise you to take advantage of some of that free content that we have. It's on our website, bogartwealth.com, and it's also searchable on YouTube. You can watch them as many times as you want to. Some really, really good stuff in there about retirement. Again, today we're going to be going over mega backdoor Roth strategies. Here's the agenda for today. We're going to go over an overview of retirement plan accounts. And then second, we'll move on to Roth conversion basics and the reasons to convert. Third, we'll jump into how the mega backdoor strategy works. And then we'll get into Roth conversions and after-tax withdrawals. And we'll finish up with some examples of the mega backdoor. All right, we're going to start with qualified accounts. So there are good parts, and then there are other parts of qualified accounts. The good part is that your salary is contributed on a pre-tax basis. And so it allows those dollars that are contributed to your employer account from shielded from being taxed at your top marginal income tax rate. So you save on taxes every year while also saving for retirement. And you pay no tax on the gains or the appreciation until that money is withdrawn. You also pay no tax on the dividends. And in most plans, you'll receive a company match on your traditional 401k, which is huge. It's free money for you as a participant. And then there's the other part of qualified accounts, the not so great parts. There is a tax penalty of 10%. It's an early withdrawal penalty if the money is taken out early, which means prior to age 59 and a half. Now that is a government set age, so there will be that 10% penalty assessed if you take the money out early. Every dollar, both the original cost and the appreciation, will be taxed as ordinary income when you take the money out, so you'll pay ordinary income tax rates on it. And you also promise to take out every single dollar during retirement. The government does enforce this promise by enforcing what are called required minimum distributions, or RMDs. And those start for every one of us starting early to mid 70s. It varies by your birth year. And there is a substantial tax penalty for a failure to withdraw these RMDs on schedule. Next up, this is employer-sponsored retirement accounts. So we're talking 401ks, 403bs, 457s, things like that. So for these, go back. So these are talking about the contribution limits for these accounts. So for your 401k, 403b, Roth 401k, the total amount that you as a participant can put in is $23,000 for the year 2024. If you're over the age of 50, you can contribute an additional $7,500 as a catch-up contribution. Now, that's not the total limit for how much can go into the plan in one plan year. The defined contribution plan limit for all sources meaning pre-tax deferrals from the employee, Roth deferrals, after-tax deferrals from the employee's paycheck, plus the employer match is $69,000 or $76,500 if you can take advantage of that additional catch-up, for $7,500. So you can see there's a pretty big chunk that can go into your employer plan. Now, the difference between the $69,000 and the $23,000 is what you can put in on an after-tax basis, which we'll get more into that later. Moving on to another type of qualified account is a traditional IRA, which is one that I'm sure many of you are familiar with. The traditional IRA, you contribute pre-tax dollars to the traditional IRA, and the limit is $7,000 per year, plus a $1,000 catch-up if you're over the age of 50. There is no income limit to contributing to the traditional IRA, but there are limits if you want that contribution to be deductible. You can see the income limits there on the right side. If you're single, and you're covered by an employer plan, it's between $77,000 and $87,000. Above $87,000, those contributions to the traditional IRA will not be deductible. For joint, that upper limit is $143,000. Now, if only one spouse in the household is covered by an employer plan, the limit is a little bit higher, up to $240,000 of income, and that traditional IRA contribution will still be deductible. Next, we've got Roth accounts. So Roths are great because the big thing, you'll see it on the second bullet point there, is tax-free growth. But here's some other things about Roth IRAs. Salary contributed on an after-tax basis if you have access to a Roth 401k. It's great because you can start saving on an after-tax basis, even if you are phased out of the income limits for contributing directly to a Roth. But the company match on Roth 401ks is contributed directly to the traditional part of the 401k. As I mentioned, the great thing about Roths is the tax-free growth, and you also have tax-free withdrawal of the principal at any point. So that means the dollars that you put in to a Roth, you can always draw those out tax and penalty free. It's the growth that you might have to pay penalty on moving down to the next bullet point, if you withdraw that growth early, i.e. before age 59 and a half, and before the Roth account has existed for 5 years, it could be assessed a 10% early withdrawal penalty. Another great thing about Roth IRAs are that they are not subject to those required minimum distributions that we talked about earlier with other qualified accounts. However, the Roth portion of your 401k will be subject to RMDs because it's part of a larger qualified account. Roth monies are great as inheritances because the beneficiaries inherit them tax-free. And here's those Roth IRA account limits I was mentioning. Again, you see a kind of a common theme with the traditional contributions, also $7,000 a year plus $1,000 if you are over the age of 50 and can do that catch up. But you are barred from contributing to a Roth IRA directly if you phase out of the income. So if you're single, anything above $153,000, you're ineligible. Same thing, married filing jointly, anything above $228,000, you are not eligible to contribute directly to a Roth. Now, as an alternative, you can also get money into a Roth IRA by doing a Roth conversion, and there are no income limits on Roth conversions. So a Roth conversion, what it is, it's just converting pre-tax dollars to Roth dollars. This can be done inside your 401k as an in-plan conversion, more on that in just a second, or it can be from your traditional IRA to your Roth IRA. Now, you will be taxed on the amount of the conversion since you're moving pre-tax dollars to Roth dollars. Now, once the money's in a Roth, all the growth from that point on will be tax-free. So why would you do this? Why would you move money from pre-tax to Roth? These are a couple of reasons favoring the Roth IRA. If you think that income tax rates will be higher in the future, it's better to have those dollars taxed today at a lower rate than at a higher rate in the future. Also, if you expect your income and subsequently your spending to go up significantly faster than inflation between now and the end of your life, if income tax rates, as I mentioned, all go up in the future. Another reason that this is a common one for people that have a lot of qualified money or a lot of pre-tax money, if they will be in what is called RMD prison or RMD jail. That is where you have such a large qualified account balance that once you turn 73 or 75, depending on your birth year, you're going to be required to take out those RMDs, and the RMDs are more than what you're spending. So you're having to take out more money than you spend. So you're having to pay unnecessary taxes. That would favor doing Roth conversions to shelter some of that qualified money from being assessed on RMDs. Another reason why you'd want to convert is anticipating leaving a large legacy to family. As I mentioned, Roth IRAs are inherited tax-free. So in-plan Roth conversions, which I touched on earlier, we can go a little bit deeper into that now. So when you do in-plan Roth conversions, you have to make sure that you consider the impact of doing NUA, which is net unrealized appreciation. That has to do with employer stock within your qualified employer plan. We have webinars that go more in depth on NUA as a strategy. If you'd like to take a look at those, we'll kind of set that to the side for now. But if you do want to dive deeper, we do have webinars over NUA. Doing an in-plan conversion is very different from doing a withdrawal, and it can have unexpected tax implications. Namely that doing in-plan conversions, it will result in some level of additional taxable income for the employee because of what's called the pro rata rule. To give an example with the pro rata rule, if the entire after-tax account in your, let's say 401k, is 60% after-tax contributions and 40% of that is untaxed appreciation or growth, then if you convert 100% of that after-tax account to Roth, 40% will become taxable income to you. Because unfortunately, with the after-tax account in qualified plans, the contributions are truly after tax, but any growth on those after-tax contributions are pre-tax. So the pro rata rule comes into play because you have to convert a portion of the earnings, and then it's taxable income to you. So moving down a little bit on the examples, if you only choose to convert 50% of the after-tax account to Roth, then 40% of that 50% will become taxable income, so on and so forth. I also forgot to mention at the beginning of the presentation, especially for those of you, there's still a couple people trickling in, the Q&A box is also open. So as I'm going through this, if you have any questions or you want clarity on anything, just drop it in the Q&A section and we will have time for questions at the end of the presentation here. All right, moving right along. So because of the nature of in-plan conversions, because there will be some additional level of taxable income, it's sometimes the mega backdoor strategy is more favorable. The reason why is because if by withdrawing the after-tax contributions and rolling them directly to a Roth IRA, it avoids taxation to the employee. Now, this is a snippet from the ExxonMobil 401k savings plan. You can see that the after-tax contributions, the post-87 or pre-87, post-86 after-tax contributions are $270,000. The big red, not this arrow, is pointing to the line item for the after-tax account. What this means is that the contributions of $270,000 have grown to $562,000, which is great. We love growth on our investments, but all of that growth, because it's in the after-tax account, is pre-tax. The only thing that's truly after-tax are those after-tax contributions of $270,000. Similar to in-plan conversions, with the mega backdoor strategy or after-tax withdrawal, The gain, there also must be part of the gain that is withdrawn from the 401k and rolled into a traditional IRA. But because it's rolled directly to a traditional IRA and then the after-tax portion is rolled to a Roth IRA, there is no taxation to the employee in the year that this is done. This is an example of a tax-paid withdrawal with the prorated calculation. So as I mentioned, the pro rata rule does come into play with the mega backdoor, but because it's rolled directly to IRAs, it saves taxation. In this scenario, we take the after-tax contribution balance of $274,000 and it's grown to an after-tax balance of $562,000. That's roughly, if you divide those two, it's 48.6% of the $274,000 of after-tax contributions that can roll into a Roth IRA. And the remaining 51.4% can be rolled into a traditional IRA. As you can see, if you've built up a large after-tax balance in your employer plan, this is a big amount that can be dropped into a Roth IRA in 1 year, much more than several years of Roth contributions if you're not phased out on an income basis. Of course, everyone's situation is different. So if you think that the mega backdoor might be a good strategy for you, we encourage you to get in touch with myself or one of our other advisors so we can run your numbers. We're happy to do that for you. We'll go through another example of the mega backdoor. So this is, let's take, for example, someone has a base salary of $225,000, which puts them in the marginal tax bracket of 24%. They're going to contribute 10% pre-tax to their 401k and after tax of 5%. We are assuming that they're over the age of 50, and so they're making a pre-tax catch-up contribution of $625 per month, and they have a 7% company match, very generous. So all these percentages, it lends them to contributing $22,500 pre-tax to their 401k and $11,250 to the after-tax portion, which is the portion of their 401k contributions that are eligible for the mega backdoor Roth strategy. The catch-up is $7,500 and the company match is $15,000, total $57,000 that's going into this person's 401k. Versus, you can see the larger amount of after-tax, $11,250, that's a lot more than just the direct Roth contribution of $7,000. So like this strategy for that reason. You can also make, so a couple slides ago, I mentioned that the total amount that one can put in their 401k if they're over the age of 50 is $76,500. We're not quite to that number yet. It's at $57,000. You could choose to top this off and make an additional special contribution to get to that full $76,500. But for this illustrative purposes, we're going to assume that they do not do that. How this translates into the mega backdoor strategy. First, you make the after-tax contribution, in this case of $11,250, directly to the 401k. It's kind of think of it as a front door deposit. And it's just the 401k is a pit stop for this after-tax money. As soon as it's put into the 401k, you then roll it out directly into a Roth IRA. That's the backdoor part. And then from there on, it grows tax-free. This chart shows the hypothetical growth of doing the mega backdoor rollover every year for 10 years with a 6% growth rate. After 10 years, you can see that $112,000 of contributions in your employer plan will have grown to $148,000. But all that growth, if you didn't do the mega backdoor and you just left it within the 401k, all that growth would still be taxable because it would still be stuck in the after-tax account. By taking advantage of the mega backdoor, all that growth would be tax-free in a Roth IRA. Very simply put, tax-free growth is better than tax-deferred growth. By utilizing this strategy over time, you could have a pretty nice balance in your Roth IRA when you retire, even if you're phased out of making direct contributions. If the mega backdoor strategy is something that interests you, or you'd like to take charge of your finances and have a financial plan run, please reach out to myself or one of our advisors. We'd love the opportunity to sit down with you and your family to run your numbers and get to know you. All of our financial planning strategy sessions are complimentary. There's no obligation at the end of them. We use it as an opportunity to get to know you and your situation. All of our advisors here at Bogart Wealth are qualified and experienced to meet your needs. As I mentioned earlier, we pride ourselves on providing education to our clients in a way that they can understand and are open to discussing any financial topics that interest you. You can contact us by calling us, by reaching out to us via email or on our website. We'd be happy to chat with you. And we have reached the end of the presentation for today. That kind of wraps up the webinar. If there's any questions, please put them into the Q&A box and I will answer them as they come in.